is in the public domain. We haven't had our full year results yet. We have a September year end, so we will be presenting our results shortly. But we're very pleased to announce that we've achieved some very strong NAV growth during the period, during the 12-month period. It's all on the fact sheet, this data. 21.7% growth in our net asset value total return per ordinary share. We've achieved an even better share price total return per ordinary share over the 12 months, 25.7, and that's way ahead of the reference index, which is the FTSE All Share. We've also delivered, importantly, for those people who like income, which I'm sure is a lot of you, we have delivered massive dividends based on an investment process which really puts income at the centre. Value and income is what this trust is all about, and we're quite different in that respect. So we have delivered some very, very strong dividends. We have guided the market. The directors have already guided that they will deliver at least 23.0p for the 12 months to September. So you will see how that turns out when the results are released. But we have said to the market that we will, the directors have said they are very determined to deliver at least 23p of dividends per share. And actually that means that our dividend yield at the moment is just over 6%, which I would argue is highly attractive in the context of that strong capital growth. We're saying to you today, we believe our investment process is differentiated enough that we're finding winners among higher yielding stocks with value on their side. And therefore, there is absolutely no compromise whatsoever between capital growth and income. We can deliver both, and we just have done for the 12 months to September. So if we move on, Ryan, just to have a look at the types of stocks that are doing that for our shareholders. And if you're not already a shareholder, I hope by the end of this presentation, you're feeling that it's one that you might consider, because we've got something here which is really playing to our strengths, which is stocks that are completely mispriced. And when I'm talking about mispricing, I can look at whichever valuation metric you want. I can talk through why the stocks that comprise this portfolio are mispriced. And if we take two that have started to play out over the last 12 months, 18 months, many more of these, by the way. So I could have presented the whole presentation today on stocks like this. But if we start with Imperial Brands and M&G, what have they got in common? Well, what they've got in common is that they're both generating lots and lots of cash, and they're able to use some of that cash to invest in their businesses, but they're also using quite a lot of that cash to pay out really attractive dividends and consider doing buybacks as well. And as that comes through, buying back debt in the case of M&G, buying back equity in the case of Imperial Brands, the market's perception of these stocks goes from one of fear, because let's face it, if you're trading on a double-digit dividend yield, and as you can see from these charts, the light blue line on the left-hand side, Imperial Brands, not that long ago, was trading on a dividend yield touching 10%. And we were talking about only within 2 years of 2 to 3 years ago, that was the yield you could have achieved. Now, how is it that they've gone from yielding 10 to yielding about 5? Well, it's not because the share price has gone down. It's not because, in fact, the share price has done the opposite. The share price has gone up. So, and it's also not because they've cut their dividend. The dividend's going up too. So how come the market was so scared? Well, it's a function of the type of market conditions we're living through. There is real paranoia about value stocks. People don't believe value stocks can generate strong total returns. Well, I'm telling you today, they are producing the best total returns. We've done some analysis on cohorts of stocks by dividend yield. And it's absolutely true to say that the highest quintile, the top 20% of stocks by dividend yield, have produced the best returns this year. And it's stocks like Imperial Brands and M&G that are able to prove that out. And we're doing that because that's where we believe we can generate both income and capital. I mean, just touching on the stock specifics, Imperial Brands just does what it does. It's decided it's going to stop throwing money at concept ideas, which might or might not work. They are going for cash flow. They've decided they don't mind being a follower. You know, look at the number of vape shops up and down the country with cheap Chinese imports. They are not prioritizing that side of their business. As that side of the as that industry develops and regulates properly, there will become an oligopoly, just as there is in traditional cigarettes. But for now, they've realized that that's not where the money is. So they're concentrating on where the cash can be generated, and they're paying that cash out, half in the form of dividends, so 5% yield, but they're also paying out around 5% in the form of a share buyback. So that's a 10% distribution yield if you add up dividends and buybacks. And yeah, that's a pretty attractive return to shareholders. The maths is playing out because the number of shares in issue is going down. It doesn't take a genius to work out that means the earnings per share is going up. M&G similarly, a very, very well run business with some great little niche positions. I mean, PruFund, if any of you have ever experienced that one, it sits at the heart of their business. It straddles asset management and life insurance, and so they really have stayed in there with the effectively a with profits fund, which actually delivers a pretty attractive return to people approaching their retirement. And this is singling them out, and in fact it's attracting interest from outside of the UK, and they've recently signed a deal with Daiichi, a big Japanese life company, who have pledged to deliver $6 billion of net flows to M&G over the next 3 years, starting this year. So we're very excited about some of these names. If we move on and look at the next slide. Now, the next slide covers, I think, something which is close to your hearts. If you're interested in income, you will want to know how sustainable is our dividend per share? And the answer is, well, we've been through COVID and we've sustained our dividend per share. We have dividend hero status. I, as the fund manager of this fund, this investment trust, I am not going to turn my back on that dividend. And so we continue to see growth in the dividend per share. And you can see that we've covered the dividend with earnings. In other words, our portfolio income has covered the dividend every year apart from 2. And I hope you will forgive me, I didn't cover it during COVID when half the stock market decided to stop paying dividends. I think you can understand the background to that unfortunate period when there was a lot of panic. A lot of companies decided, let's just hoard capital. And so we went through a very troublesome period, I would say, for this trust and for many trusts during that period of really having to try to generate as much income as possible. Of course, now what's happened is we're back on an even keel, and the opportunities, the mispricings are significant, partly because everyone's so discombobulated after such an extraordinary period. So if we move on, Ryan, and look at the next slide, I mean, let's put this in context. I have already talked today about this focus which we have on cash flows, and that's what drives dividends. So if we start at the top, the 3 things I want to see in aggregate in the portfolio: dividend yield, absolutely determined to deliver for our shareholders. We think that will mark us out from other investment trusts. If we can keep delivering that dividend, not just a high level of dividend, we want to achieve a growing level of dividend. So that explains the right-hand blob there, dividend growth. We want to achieve both. And we want to find companies like Imperial Brands and like M&G, which can do both. It's not one or the other. They can do both. And suddenly we're finding that, 32 of our holdings out of 55 are doing share buybacks. Well, that's the answer. That's part of the answer in a slow growth environment, in a macro environment which is gone very, very cold. We can talk about that maybe in Q&A if anyone's interested, but the Chancellor stands up today. I don't think anyone's got any great hopes that the UK economy suddenly springs into life, but companies are doing big buybacks. Companies are paying out dividends. The net effect of that is that dividends are growing. And then finally, capital growth. If we're buying a stock on a single digit price earnings ratio, we believe if things go well, that stock has got the potential to re-rate. In other words, it will no longer be trading 8 times at the end of 2026. It should be trading on 10, 11, 12 times earnings. And the dividend yield will compress from whatever we start at. Often we're buying stocks on a yield of 6, 7, 8%. And those dividend yields, sure enough, are crunching in. They're compressing, and we're ending up with dividend yields of 4, 5, 6. And so we're generating capital growth, not the way that many growth investors will tell you is the only way to achieve capital growth. Oh no, because it's not the only way to achieve capital growth. We can achieve capital growth by buying mispriced stocks which are set to achieve a significant valuation re-rating. And we believe that's playing out. So if we move on, Ryan, just to see the next slide, which really covers how we do it. So we spend lots of time before we invest in a company, meeting the company, working out what the key drivers of that company are, what will drive the earnings, what will drive the cash flows, what will drive the dividends. I've talked about Imperial Brands as one such example. Then we talk about what the market will pay for that. So we've done the analysis, then we do what's the judgment on that. So should that stock really be yielding 10%? Of course it shouldn't. Now, can it yield 8? Yes. Could it even yield 7 or 6 or 5? Well, yeah, that's what we're doing. So we are seeing this significant crunching in of dividend yields. And then that is driving share prices. So if we do that successfully, rinse, repeat, we're going to generate some capital growth for our shareholders. And that's why I'm excited, because we're only at the foothills here. We are not anywhere near through this potential re-rating of UK stocks. In fact, more than half the market by number is currently living in fear of the latest misstep by Rachel Reeves. The policy at the moment is not supportive for UK stocks. That's why I've been quite careful about how much we expose our shareholders to UK domestic stocks. If we move on and talk about that in a bit more detail. So we do the idea generation. We look at where are we finding the best ideas. We run it through our quant model. Now, what's important there is that you may say to yourself, well, I've heard all this before, seen fund managers present. They all say they've worked it out. What's different? Because we can all have bad spells. Well, the difference here is I'm putting the quant model, which is tried and tested over decades, to work every week to screen for stocks with the best combination of value, including yield, and revisions. To me, those two aspects make all the difference, because if you can have value on its own, that's all very well, but there's no catalyst for that stock to perform. You need revisions. So you need earnings momentum, you need sales momentum, you need dividend momentum. And that's what we're now seeing with Imperial. That's what we're seeing with M&G. People thought that the dividend would be cut in both cases. Turns out the dividend will grow. And then we put that together in the portfolio and we try to generate an outcome for shareholders which isn't too bumpy by selecting stocks from across different sectors, different risk factors. And that's this science behind what we do. And then we really think about the behavioral side of it as well. So I've thought long and hard about this. Coming into work every morning, how much conviction have I really got? Would I start that position from scratch today? It's a great question to ask, even in your own portfolios at home. What is it? Just because you've got something, does it really? If you were starting from scratch, would you really own it? And I think that's a great way of sharpening your execution. So moving on, I think the portfolio on the left-hand side here. What we've done here is we've presented the portfolio. On the left-hand axis, you can see the dividend yield. So you can see there are stocks ranging, all the way up to 11% dividend yield. we're comfortable with all of that, all of these stocks, you know, even if they've got a lower yield or even no yield, if there's potential for that company to come out with a positive change and positive revisions, well, that stock can re-rate quite sharply. So we're very happy with a big spread on yield, and also a big spread on market cap. It's been a good year to own large caps and mega caps. And over on the right hand side, you can see we've got stocks in excess of £50 billion market capitalization, but we've also got stocks at 100 or 200 million market capitalization, because we want to go anywhere. We want this to be a go anywhere trust that can differentiate itself from its peers, because I only own stocks I have the strongest conviction in. And that means that at the moment, we have currently about 45% in large caps. The index is nearly 90%. We have the rest of our portfolio in FTSE 250, FTSE small cap, and other stocks, all of which are London listed. So moving on to the next slide, we can see the valuation metrics. Now, at the beginning of the presentation, I said to you, look, I can explain the logic of this portfolio based on the valuations being completely wrong, with significant potential for re-rating. And this slide is an attempt to show you just how much re-rating potential this portfolio has. So if we start with something, you know, you've all heard of price earnings ratio. You probably look at this when you're investing in individual stocks yourselves. This portfolio, and this is bang up to date, this portfolio has a median PE 9.9 times, and the wider market is just under 12. So that's a nice big chunky discount. The median dividend yield is 5.3%, I think that says, and the median dividend yield for the market is 3.5. What's important for me, if we work our way across this, by the way, is what's backing that up. So if you were just paying dividends out of capital, that's not real. But these companies are paying dividends out of cash. Free cash flow yield of over 10% for this portfolio, whereas the free cash flow yield, in other words, all the cash that's left over after they've done all their SG&A, they've paid their salaries, paid their expenses, paid all the fixed costs, and they're left with 10% left over as a percentage of their market cap. The market is only 5.5. Dividend growth, not quite as fast. I'm happy with 4%. It's, you know, we're not going for growth because, as I said at the beginning, you generate capital return if you find mispricings. It doesn't need to be the highest growth stocks in the market that deliver you that capital growth. And the returns, again, people will talk about quality. I'm very happy that despite being significantly undervalued, these stocks have got a return on equity very similar to the wider market. Price to book, 1.1 plays 1.6. Now that is a massive disparity. If you were looking to replace all the buildings, all the equipment, all the capital, you know, I'm getting all of that for just over 1 times book value. If you try and do that for the wider market, you're paying a 60% premium to book value. So it's a significant difference, and far lower net debt to EBITDA. So the gearing is much lower as well, which means these companies on balance, they're safer. They don't have as much debt. So that's valuations. If we move on and talk about what we've seen in the last year or two, I think it's important to say significant number of stocks with buybacks. So that's quite an underpin. You know, people go on about there not being much in the way of interest in the UK market. Well, there's an awful lot of buying being done by the companies themselves. And by the way, there's an awful lot of M&A activity. So there are incoming bids for many companies. We had 4 bids in 2024, the year 12 months, September 24. We've had 3 bids in the year to September 2025. So 7 bids. You know, bear in mind, we only have 50 to 55 stocks typically in our portfolio. That's quite a big hit rate because other companies, typically from overseas, private equity companies, are seeing the value just as we are. And we've also had lots of special dividends. So if we keep picking stocks which have got this potential, for massive income payouts in the form of special dividends, massive buyback potential, and M&A interest, I think that sets us up quite well for the year ahead. If we move on, we can see here the top 10. I won't go through each name, but I think I've already touched on some of these ideas, M&G and Imps, for example. But lots of these names are delivering really strong capital growth. And look, some of them are large caps. I'm not afraid to own large caps, because sometimes you think, well, how can you be right about a large cap? How can you, Thomas Moore, be able to select a large cap and generate more than the benchmark return? Well, look at HSBC in the last year. It's gone through the roof. Look at BAT. BP's starting to have a very nice run at the moment because there's so much self-help there. We talked about Imperial. Rio's is something I added to quite heavily. If you look at the fact sheet in September, you'll see my reasons for adding to Rio Tinto. Very exciting situation there, building, and a lovely yield of about 6%. And then we got lots of mid caps and small caps like Galliford Try, Peters Hill was bid for, so that's now come out of the portfolio. Chesnara, Balfour Beatty. Again, quite a nice healthy balance, I would say, between the mega caps and the smaller and mid-sized stocks. So moving on, we can see the matrix just helps us stay on top of how we're positioned. And the matrix key messaging, 5 big factors here. First one is on the left-hand side is price momentum. And I suppose it's no surprise, given we've done over 20% return, we've got lots of that. Many of you will know from bitter experience, share prices beget share prices. Momentum begets momentum. I'm not afraid to run my winners. It's one of those lessons you learn over time, isn't it? Cut your losers, run your winners. We've got value on our side. So some people will say we've got momentum, but then you'll ask them what the valuation is on their portfolio and they'll say 25 times earnings. And I'll say, no, thank you, because there's no valuation re-rating potential. We have valuation re-rating potential. Growth is just below the line. As I said, no issues with that. That for me is, there is no red flag there. There are where we go wherever the mispricings are. It could be that if these growth stocks carry on derating, we're able to buy the likes of LSE, Sage, and Relex on rock bottom valuations. Who knows? We'll wait for that moment with excitement. But we've also got positive earnings revisions, and I think that's really important. So we've got those catalysts coming through for our stocks to carry on re-rating. Moving on to the next slide. This is just to give you an idea. These are the top 15 stocks on our quant model at the moment. So I thought, bringing it bang up to date for you, which stocks in our portfolio have got the biggest bang for buck at the moment? And the answer is actually quite a lot of, good range here between small caps, mid caps, and large caps. But actually, some of these stocks we've been buying fairly recently. So we bought a position in Polar Capital, 8.5% yield, fund flows turning, and a very impressive new CEO who's come in and believes he's going to be generating some significant fund flows in the coming years, based on a strategy that to me makes a lot of sense. Just deep insights in a small number of niches. And I won't go through every name, but that's just to give you a flavour of stocks that score well overall on our quant model, but also stocks which score well on value and revisions, which I've said to you, those are the 2 key drivers for how we believe this portfolio can continue to deliver strong net asset value total return going forward. So moving on, Ryan, this is total return performance. What stands out, I think, is we're outperforming. We're outperforming based on NAV total return. We're outperforming on share price total return. Some platforms only tell you the price. Hargreaves Lansdown, for some reason, can't sort out its systems, and still, if you look on that, you'll see they only refer to price only rather than total return. Never quite understood that. We're yielding 6, so if you add that in, which we're doing here, the total return, the capital plus the income, I see the 6 as a bedrock. Every year you can have confidence. We've got massive reserves as well. You can have confidence. We do the 6. Okay, so that's our bedrock. Now, on top of that, if we're right about some of these ideas, we can generate some significant capital growth as well for you. So I think that's exciting. And I think we finish off, if we finally, with a slide where I just wanted to explain, I think we're resonating with shareholders. That we've got a growing shareholder base from direct to consumer platforms like Interactive Investor and Hargreaves Lansdown, despite only quoting my price only, which I'm very upset about. Look, it's a great time, I think, for individual shareholders to be investing in and making their own decisions, and hopefully giving people like me the ability to spread my wings, invest across the UK market, find some winning ideas for you, pledging to you that I do my utmost every year to outperform. Is in my blood to do that. I want to do that every year, year in, year out. I believe I can stay fresh in this portfolio with the help of that matrix quant model. Go wherever the returns are. Don't get bogged down in specific styles. Don't be hoisted by your own petard. And just go for those returns. And so I think that this slide shows you that the message is resonating, and that's reflected in what was a big discount to NAV turning into what's quite regularly a premium to NAV. And I want to keep it there, and I want to issue more shares. We've actually issued over 1 million shares in the last 12 months. I want to carry on with that. I want to give you the confidence to know, if you invest with Aberdeen Equity Income, I've got my heart in this. I want to deliver for you, and if I can justify that premium to NAV, we can issue more shares, and that's what gets me out of bed every morning. So Ryan, back to you.
Thank you very much, Tom. That was, as ever, a very interesting presentation. We have had quite a few questions come in, so we will turn to those. You've finished a couple of minutes ahead of time, so we might have a moment to get through all of them. Given you are an equity income manager, we're going to start with the income question. So I'm just going to turn us back to the dividend chart. Could you just talk us through the revenue reserves situation of the trust, please?
Thanks, Ryan. That's a great place to start, because those of you who are investing your hard-earned savings want to know, can this continue? Can this 24-year track record of continuous dividend per share growth continue? One of the questions you need to answer in order to get to the answer to that question is reserves, because there will in the future be more rainy days. Frankly, it's felt like rainy days for the last 5 years or so, really, ever since COVID, because things have been pretty tough, but we've carried on growing the dividend. Now, to answer your question, we have about 3/4 of the year in reserves. So we have about something in the region of 9 to 10 months of reserves. And that gives us quite a lot of confidence, because we've during COVID, we showed the market that's what they were there for. The question is, will we have another COVID? I think that was an exceptional period. We are eking out dividend growth. Portfolio income in the trust is heading in the right direction. And so I would say, look, combine those two things, underlying income growth and this reserves of 3/4 of a year, and you've got, I would say, conversation with my directors when they ask me, look, what's the outlook? I'm able to say, well, look, it is still a subdued outlook for the economy, but with all these buybacks and the reduction in the share count of all these different companies, they are achieving dividend growth, believe it or not. So Brian, that's probably my best answer for that question.
Great, thank you. I'm now going to collect a series of questions about the portfolio itself and sort of where you can and can't invest in together, and then we'll turn to some questions on macro and some about performance as well. So just on the portfolio questions, one that we've had come in was about overseas allocations. I know you've talked about your plenty of opportunities in the UK, but can you invest in overseas companies, and would you?
It's a really interesting question. Now it's a live question. It's always been a live question. And I can remember having this discussion with the board of directors going back years. And the answer at the moment is we are a UK only trust. Of course, that means we still have significant overseas exposure because famously the UK is a very international market. Just under 80% of revenues are generated overseas. And the likes of Rio Tinto, HSBC, some of the biggest positions in this portfolio, bear that out. You know, we are generating lots of overseas income already. The question of whether we extend the universe, you know, beyond the UK is as I said, it's always a live debate. When I think about the number of companies that have delisted from the UK in the last 5 years, I think it does become a more pertinent question to ask. Is there a benefit? I think you could have said 15 or 20 years ago when there were hundreds of stocks, you know, literally, you know, back in the, you know, I've been doing UK equity since 1998. The number of stocks listed in the UK has shrunk dramatically. So I'd say, look, Ryan, it's something we will keep open. I've got a board meeting. Interestingly enough, I've got a board meeting on Friday, and I'm sure it will come up again there. So live debate.
Interesting, thank you. And just actually, while we're here on the UK market, actually, we'll just touch on one about the AIM, which I see you've got a small holding in. What do you think is the future for that market? Now, bear in mind, I will ask you about budget later on, so we'll maybe touch on that there. But just the AIM itself has been really underperforming, struggling for a while. Are you still able to find opportunities there? And do you think the market will persist?
Yeah, there are still tax advantages. So I'd say, yeah, as much as many companies are seeing it as a bit of a curse being listed on AIM, I'd say that's a short-term reason to be worried about it, because of course, you know, there are fund flows, there are funds that were invested purely in AIM stocks for the tax advantages. At the last budget, the inheritance tax benefit of investing in AIM was halved from 40% to 20%. So that caused some funds to wind up, the funds that have been doing IHT friendly investing in AIM. But 20% is still a saving. You know, there's still a tax reason you might want to invest in AIM stocks. So I'm pretty ambivalent about it. I'm not worried about owning AIM stocks because I think that any fund flows out of AIM stocks are very short term and short lived. And actually, you know, it's up to the individual companies to work out, do they think there is sufficient reason to remain listed on AIM? Slightly lighter touch in terms of listing requirements and reporting requirements. So it's a slightly lower cost place to exist. At the margin, if that encourages company to remain listed, then that's a good thing.
Interesting, thank you. Now on sort of the portfolio itself, we've talked through sort of some of the valuations and things, but on specific sectors, can you just talk through some of the largest overweights and largest underweights in the portfolio, please?
Right, that's great. Yeah, on our fact sheet, we show both the absolute positions, because we do think in absolute terms. One of the characteristics of this investment process is we're index agnostic, but we also show the overweights and the underweights because we think that provides a benefit to our shareholders to be able to look at where we've got a difference from the wider market, where we believe that there is you know, where we believe that there's a you know, a benefit to us owning that stock, and where we think the stocks that will enable us to deliver outperformance. And so if you have a look at the top 10, you can see here clearly there are some very big cap stocks in this top 10. So the very large stocks: HSBC, BAT, BP, Imperial Brands, and Rio Tinto. And so that gives you a flavour of where we've got conviction in large caps. The other stocks in this list of 10 will be the largest overweights in terms of relative weighting. So we've got Galliford Try, Petershill, M&G, Chesnara, and Balfour Beatty. And And so I won't go into detail on all of them, but what I would say is if I give you the one-liner on each of those in the interest of time, Galliford Try is a multi-year growth story. Now, the reason many of you will have lived through very dark periods for the construction sector. Carillion, some of you even remember Trafalgar House. Now, if anyone who remembers Trafalgar House back in the early 90s, you get extra points because that company went bust. I remember my father had a shareholding in it, and that caused some consternation at home. It was a horrible industry. Things have changed. What's changed is there is now a focus on treating their suppliers well. They are able to generate better returns because typically these are contracts they win from government, public sector, either nationally or locally. This is the main source of contracts. And suddenly the industry is behaving in a disciplined manner. There isn't the same competition that there was for contracts at ridiculous operating margin, which caused the issues for companies like Carillion. So that is a multi-year growth stock, Galliford Try. And if you look at the investment going in, the latest water regulatory review was AMP8, significant growth in capex. It's going to come through in your bills, I'm afraid. Another reason why you might need a high yield investment trust. So that's Galliford Try. I would say Petersill's now done. We've sold it. It was trading at half book. We bought quite aggressively in 2022 and 2023. It re-rated when the majority owner Goldman Sachs decided to take out their minority shareholders. M&G I've talked about. Chesnara is a wonderful little closed book life company, just doing what they've done for 20 plus years, generating value by buying books of business at a discount to NAV and then running them for cash. They seem to be able to do that more efficiently than anybody else. Balfour Beatty again is very similar to Galliford Try, apart from their focus on the power sector. So they're exposed. If you want the tools that will power the AI boom, I would say don't buy the chip stocks, buy the picks and shovels, which is the likes of Balfour Beatty. Hope that's okay, Ryan.
That's brilliant. Thank you. The next question on the portfolio was about to be about construction anyway, so you've just squared that off quite well. Thank you. We're just going to turn to performance quickly. We've had a couple of questions come in. Now, in the presentation, we've shown the 1 year total returns. Can you just talk about sort of the longer term track record? So you've done quite well recently, but can you put that in context and as to why it's been so good over 12 months?
Sure. I mean, I'm not. What I don't want to do is give you a sugar-coated view. I mean, we're doing well on a 5-year view, but we had a very poor COVID. If you roll back further, our performance is affected by a couple of drawdowns, notably Brexit and COVID. So I've had a lot of soul searching. How am I going to minimize the risk of another drawdown like that? Because they are not fun to live through. When you're wearing your heart on your sleeve, it's not fun coming along to an event like this, speaking to shareholders and potential shareholders and having to explain one of those. So I would say, look, one of the things we've done, which is really helping to future-proof performance, is we have said, I've sat down with my performance, my investment governance people, the risk people, and I've said, look, there is a time to be long term when you have a view of a company that can play out over 5 years, and that's the likes of Galliford Try, by the way. So those stocks just sit there and enjoy the ride. There's also a time to be aware of stocks that actually are more geared to macro variables, and be careful with your exposure to stocks which are heavily affected by macro. And so one of the things that you'll notice about this portfolio relative to the portfolio 5 years ago, just before COVID or just before Brexit, is we have far less discretionary variable earnings stocks. Of course, there will be some which make the grade, but in general, in aggregate, what we've done is a lot of work on the risk. So we've got the beta of the portfolio below 1 times. I looked at it this week, 0.97. I'm quite proud of that, because this isn't a portfolio that's driven by risk considerations. I want to make that absolutely clear. But I also want to make sure we don't stand the same likelihood of coming a cropper next time there's a big macro event. And if I'm running a beta of 0.97, I think that sets us up really, really well for delivering performance through the cycle and not having to worry massively about, some sort of, let's say Rachel Reeves blows the bond market up this afternoon, today. So we're Wednesday, the 26th of November. We're all slightly thinking ahead to that, aren't we? Let's face it. I hope you're still concentrating on what I'm saying, but you're probably looking at your clocks and thinking, in less than an hour, she starts speaking. I've positioned this portfolio very, very carefully into this announcement, because she's, quite frankly, she's how do I put this politely? She is making us, she's making everybody a little bit nervous, shall we say. She's her policy making is, shall we say, quite fleet of foot. Should we say that is a polite way of putting it? Things are changing by the day. Her policies seem to change by the day. Therefore, we can't go into this with a significant amount of confidence that everything's going to pan out well. And that's why you'll see companies like BAT and HSBC, which are actually set fair, whatever she says, right at the top end of the portfolio. Now, when that changes, when we have confidence that policy making is becoming more stable and pro-market, we will be ready to invest in the UK domestic names. But I think that's a big change. And Ryan, you and I have been speaking. Ryan's work, by the way, he underplays himself. Ryan has worked at different houses over the years, and I've met him when he was a client. The questions that you asked me back in the day on the macro, all of that has sunk in. And, it's very important that we think not just in terms of maximizing our total return, but also thinking about the downside risks as well.
Brilliant. Thank you, Tom. It's a little bit of insight into my background as well. Now, we're just going to I was going to ask you about the budget, but I think we've covered that off now as well. So I think we might, just with a minute to go, just cover off a little bit of sort of client education, if we can. Maybe you can just talk through buybacks. Obviously, we know how they work in the investment trust space, but can you just talk through the dynamics of how they work for actual companies you hold and why that is good for total returns?
Yeah. I'll try to do this really briefly, Ryan. This is something that really engages me, and I hope I can get you engaged on this as well. So if you think of a company, let's keep it simple. Okay, so we have a company making £1 of earnings per share, and they've got 100 shares in issue. Okay, so if it's on a 10 times earnings, that'd be £10 of earnings. So £1, so 10, it'll be £10 per share because 10 times earnings. Okay, so that's your first that's where we are now. Now, if the company buys back 10%, or let's keep it really simple. Let's say the company buys back half its market cap over a period of time, which is sort of what Imperial Brands are doing. Okay, so instead of having 100 shares in issue, you've got 50 shares in issue. And let's not give them any credit for earnings. Let's say the underlying earnings are flat. Companies still make the same absolute amount of earnings, but you've got half the shares in issue. Your earnings per share are going to double. So instead of being on 10 times earnings, you're going to be on 5 times earnings. These are obviously, look, okay, the reality is there's ceteris paribus, other things intervene. And some people will push back and say, oh, well, these must be ex-growth businesses. As I think we're showing with Imperial Brands, ex-growth businesses can still have rising share prices. Tobacco, nobody says tobacco is a massive growth industry. As it happens, they are growing the profits, both in absolute terms, but particularly in per share terms. The share price is going up. So look, that's, to me, is the excitement, is buybacks, the maths is playing out, is a good way of putting it. It's about numbers. We talk a lot about stories, don't we, in investing? And stories can get you into all sorts of trouble, because you'll hear slick salesmen, you'll hear snake oil salesmen telling you about their latest growth idea. To me, it's just airy-fairy. A lot of the time is nonsense. I don't believe in that style of investing because technology is constantly changing. Good luck to you trying to stay ahead of the latest trends in whether Nvidia is going to be surpassed by some unknown Chinese company. I have no idea, and I don't want to engage in that sort of pursuit because I'd rather look at the numbers, and I can be much more certain that the likes of Imperial Brands is going to have a significantly lower share count thanks to the buyback, and that will drive up earnings per share. So if the share price can't stay flat if you halve your shares in issue, it just can't. It would be mad if it did. So that's what I'm just trying to keep all of this simple. And if we can deliver the 6% yield and have more than half our portfolio doing buybacks, that's a good, to me, that's like, there's a formula there for delivering a total return that's better than the wider market.
Brilliant, Tom. Thank you. Well, on that very quick lesson on simple mathematics, it's probably a good time to wrap up and hand over to Rachel Reeves. And I think gives everyone just enough time to go and get a coffee or something slightly stronger. Just leaves me to do a bit of housekeeping and let all the listeners know that the slides and a replay of the webinar will be available in the coming days on the KTI website with a summary of all the presentations we have during the week coming out soon. If you'd like more information on the trust, please visit its profile on the KTI website or Aberdeen's own website for that matter. Just leaves me to say, Thomas, thank you very much for your time. We really appreciate it, and we look forward to seeing all of you again soon. Thank you.